Hello and welcome back to the Wise Money School here on YouTube. I'm Krisstina Wise, your millionaire coach. I'm an American Express user, and part of American Express is they send me a number every single month. I have this number, you have this number, but very few of us understand anything about this number. And this number is so important that it really reflects our entire financial life boiled down into this one number. And it's called a FICO score. So it's your credit score. What is a credit score? What is a FICO score? Why is it important? Why is it important to keep it a high number? So I'm going to talk about that today. And just a little background, it's basically your credit score is broken up into these two parts. And part one is what's called the reporting agencies, and that's TransUnion, Equifax, and Experian. So there are these three main credit bureaus, and they have nothing to do with your score. But what they do is they collect all this data that's about your payment history and collections and judgments. So they just collect all of this data, and they don't have any say into whether you have good credit or bad credit. They're just the data collection when it comes to credit. Now the other side is what's called the FICO score, and this is a different kind of institution, and it started back, I think maybe the founder of it was Isaac, and it's called the Fair Isaac Corporation, which is where FICO comes from. And what this organization did, it's like almost a monopoly, but this organization is they created all these algorithms that basically gave a scoring to the data. And that's called your FICO score, that if wherever you are in this certain score, it basically says your risk or your credit worthiness. And then, so they pull all the data from the institutions and they give all that data as score. And that's it. You have your FICO score, I have my FICO score. So my American Express today, it says, hey, Krisstina, your FICO score is 801. So that's great, 801 credit score. So I'm going to talk about these credit scores. But I actually have my credit that I get reported once a month just to keep an eye on it, because if it goes way down, maybe I've been hacked or something that's happened. So anyway, I'm watching it all the time, but our credit scores are really important. So it's really important, anything that's important, we want to keep our eye on it. So let's talk about our credit scores. Now, if you've applied for a loan, a mortgage, if you've applied for a car, they're pulling your credit. I just was refinancing a piece of investment property, going to do some construction on adding another unit to a piece of property. And so going to the lender, what did they ask for? They asked for my credit score. So again, I've been thinking about this because they asked for the credit score and American Express just sent me my number. So what are these percentages? So it's broken into exceptional, very good, good, fair, and poor. So based on what range you're in, basically tells the lenders how risky you are. Obviously, if you have a poor credit score, pretty risky, meaning it's very likely you're not going to pay your bills. But if you're in the exceptional, then it's very likely you are going to pay your bills. So anything that's at 800 plus is exceptional. And that means you're going to get the lowest interest rates. You're basically just almost risk-free. Obviously, any type of lending institutions love anything above an 800. So really easy to get credit when you have an 800 plus. I don't know what percent of people have over 800, but it's a small number. So, but the goal should be to have an 800 plus credit score. I want everybody to really have that goal to have an 800 plus credit score. So then we have what's called 740 to 799. And if you're in this range, this means, yeah, very good credit. So if you go get a mortgage, if you're in this range, you're going to be in good shape. Anything very good and exceptional, really easy. They're like, hey, you're low risk, approved, basically. Then we have what's, I think it's like 670 to 740. That puts you in a good, means you're still pretty good, average. You're doing okay. You pay most of your bills. And then, we don't want to be in these brackets, which is the fair and the poor, but fair is 580 to 669. And then anything below this 579 is poor. So those are our ranges. And, we want to sit in this, and I'll talk about the reasons why. But yeah, we want to. And so if we're in any of these lower categories, the goal is to keep popping this up. So that's what our ranges are. Now, what determines where we fit in these numbers? And so this is important to understand. And I used to be in the real estate business, and I help buyers all the time buy houses, and you have to get a mortgage. Almost everybody gets a mortgage, and so they'd go to the lender. And so I became very familiar and really learned this credit scoring system so I could work with my buyers to help them understand and do some prelim work so that we didn't get into having them under contract and all of a sudden they pulled the credit score and we found out some information that wasn't positive and they ultimately couldn't buy the house. So I started researching this and just really learning to understand it for my own sake, but mostly for my clients so that I could educate them so that, again, we'd be prepared financially and this credit worthiness before they went in to apply with the lender. It's ranked when they look at your credit score, they give a certain percentage of importance to each one of these 5 things. And so if you want to increase your credit, you're really looking at this. So the first one is your payment history. So your payment history, so that's pretty self-explanatory. It means you pay your bills on time. So that's weighted 35% of your credit score, that if you make all of your payments on time, it's, 35% is going to, that's weighted to give you this higher score. So if you miss one payment, you get dinged a lot. So, I mean, it's crazy. Just missing one payment, your credit score might go down by 100, just one 30-day late pay. And I had one of these. I've had 800 credit for basically ever once I learned this, because I always wanted to keep my credit score high because I like buying a lot of real estate and other things. And so what had happened, this was back in 2008, and I had a loan with Wachovia Bank, and Wachovia Bank was one of the banks that went under at the time. And I can't remember all the details. This was, many years ago, like 2008, 2009. But they went under, and I think Bank of America took them over. Somebody bought them. But somehow in the transfer of that, my automatic payments got cut off, and I didn't know. And I had one 30-day late pay, and it dropped my credit score to, somewhere in here. And it wasn't even my fault through all this. I missed it because I didn't get word, and it dropped my credit score. So just one 30-day late pay can make a big difference. And so what we want to do is we want to make sure to always be on time. And this is something I taught my young adult children. One, be careful with credit. We've talked a lot about credit cards and how dangerous they are. They weren't allowed to get one in college because they're like, hey, Mom, on the college campus, they're saying I could get a free XYZ if I sign up for a credit card. I'm like, no, they're predators. They're trying to, get you under a lot of debt in college. So they weren't allowed to apply or get even close to a credit card in college after they turned 18. And college campuses they're so predatory on college campuses. And that's where it starts. You start getting debt with student loans and credit card debt in college. But outside of that, it's like, okay, now that you're out of college and you need a credit card and we need to start establishing some credit, this is how it works. And here's the thing, always pay on time, always pay on time. And then one of my credit consultants, I'll talk about him in a minute, debt consultants and credit consultants, his name is Devin. And I asked Devin, I said, what's a tip when it comes to your credit score? And he says, auto pay. And I thought that was just such a great tip, that put everything on auto pay so that you never miss a payment. And if times are hard or something, just try to preempt it with calling the credit card company, calling somebody to do anything to not miss a payment and to keep your payments on time. All right, so the second one here is weighted 30%, and this is, how do I say this? This is the amount, this is your balance to your credit limit. So it's like the amount owed to the amount that you can access. And so this is 30%, so this is a big deal. And what this means is if you have a credit card that has a $2,500 limit and your balance is $2,500, that's a ding because you've maxed it out. So if you have one credit card, and it doesn't matter if you have 1 or 5 credit cards, they're all weighted the same. So, but if you have 5 credit cards and they're all maxed out, same thing, like ding, 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 and that's really going to drop your credit score. So to increase your credit score, what we want to do here is if you have a $2,500 limit, maybe you have a $500 balance at most, that ideally you're paying it off every single month. But you just want to make sure that you have a big difference between what your balance is owed and credit limit. And how you raise it is like if you have $25,000 credit limit, say between 3 or 5 cards, and then you only have $500 balance, but they're active and you're paying them off, again, that really pushes up your credit score. It just shows, what it's showing the lenders is that, hey, they could borrow, max out borrowing, but they don't. It just says you're more responsible with the credit that you have available and that you're able to pay it off. So these are the two primary, that if you're making all your payments on time and you have a big delta between your balances and your credit limits, that's the primary influence over this number. So these are the two things we're looking at if we want to start increasing the credit score. Now the one here that a lot of people don't know is what's called the length of credit. And it's 15%. And this one I didn't understand. In fact, I made a big mistake here early on not understanding this. What that means is how long you've had like a line of credit open. So if you've had a credit card for 20 years, that's a really good sign. So you want to have credit cards that are open for a long period of time and that they're relatively active, even if you just put something on it once a month and pay it off to keep those credit cards active. But that's what the lenders like to see, is that you've had credit for a long time. So that's when you're coming straight out of college or the thing, like you have low credit scores because you've not established credit yet. And I got in trouble here actually because I had a big payday. I sold a company and I paid off all my mortgages. I paid off every piece of debt that I ever had, and I closed all of my credit. So all my mortgages were paid off. So those are closed, and any old credit cards and everything, I just paid everything off and I closed the accounts. And I didn't know it, but my credit score really dropped. And it's because I wiped out all the longevity of all the accounts that maybe were 5, 10, 15, 20 years. And I more or less had to start over on this weighted piece. So yeah, you want to start credit early, make sure you're taking care of these two pieces, but then keep these cards open and active, because that does influence your credit score more than you would think, certainly more than I thought. So make sure that you don't pay them off. And I guess that it's a myth that says, hey, to improve my credit score, or it's better to close all my credit cards after I pay them off. It's like, no, pay them off and leave them open because of this. So many people applying for loans had done the same thing, and we're like, no, don't pay off those, don't close those credit cards. It's great to pay them off, don't close them, because it can really reduce your credit score. So the next one here is called credit mix. And there's two types of loans. There's what's called an installment loan, and there's what's called a revolving. So an installment loan is a fixed loan every month. So your mortgage is an installment loan, like it's a fixed payment every month. Your car, that's an installment loan. Any type of loan you have is usually like a fixed loan. It's an installment. Maybe it's 5 years on a car loan or 30 years, but it's an installment loan. Your credit cards are called revolving loans, and your revolving loans mean it fluctuates every single month. Sometimes it's higher, lower. Those balances are revolving, and they give more weight to revolving credit cards. So if you only have installment loans, you might want to open up a credit card, for example, to have that revolving credit on your credit report, because there is weight in there. But you want a mix of both installment and revolving if possible. And I think that I said like 3 to 1. Like if you have one installment loan, have 2 to 3 revolving for the highest mix. But the point is that they're looking at both installment and revolving as part of that score. And if you have just one and not the other, it might have some negative influence. And the final one here is new credit. So new credit, this is another thing I talk to my kids about, but I'm sure it's for you. If I go to the mall and I'm going to, Banana Republic, and in fact, over Christmas, I went into Banana Republic because my son loves Banana Republic. That's the clothes that he likes. So I was going in to buy him, of course, some clothes for Christmas. And what do they say? you can save 25% today if you open up a credit card. Then I went across the way to Gap to buy another present, and what did they say? Oh, Krisstina, you can save 25% today if you sign up for a credit card. Every department store, every store I went into at the mall to buy Christmas presents, they all offered me a free credit card. And when you're buying some bigger purchases, it can be pretty seductive. Like, and be like, that's a lot of money. That's a few $100 to save. Maybe I should open a credit card. And especially on furniture. So my husband and I went to a furniture store. We needed outdoor furniture at World Market, and they were having, they're having a sale, love sales. So waiting for the outdoor furniture sale to go on that was like saving 15%. And then they said, you can save another 20% if you open up a credit card. So this was a lot of outdoor patio furniture, and it was many thousands of dollars. And so adding that up, we looked like, damn, that's like saving $1,000. Let's open up a credit card. So we did that, but that's just because the savings were just too great not to. But my point is that no matter where you go, they're saying sign up for a credit card, sign up for a credit card. And every time you sign up for a credit card, it dings your credit. So you just have to know that if you're trying to keep a higher score, that's going to ding. Now the good news is if you, on these new cards, if you sign up for it, get the credit, pay it off, and close the account, your credit score will go back up. So that is a tip there, that if you are taking advantage of all these, it is going to ding your credit. But if you pay them off, close the accounts, it's not going to be immediate, but you can start, you're going to start getting those bonus points again. But it's just to keep in mind that it's a detriment to your credit every time you open up new credit. Now, what I sometimes get asked is like, hey, I'm buying a house or buying a car and all the lenders are dinging my credit. Is that going to really affect my credit score? And no, I think it used to be that way, but it's changed that within like a 30 to 45 day period, if you're getting lots of what's called inquiries, kind of the dings, people are looking at your credit, is what they do. Like every time Banana Republic or World Market, they're all going to look at your credit score, and it shows up as an inquiry. So if you have too many of those inquiries or new opens, obviously that's you're getting penalized. But with these new credit cards, you can pay them off, and it's not going to affect your length of credit here with some of your old ones. So just keep in mind that every time you apply for credit, it's going to have some type of impact, and that you want to be paying attention to that. But if you are buying a car and all of a sudden you have 15 inquiries because you've gone to 15 different dealerships, that's not going to have a negative influence, because the credit card companies know you're probably shopping for a car or for a mortgage in that example. So you don't have to worry about that. All right, so this is how it's all weighted out. So if we want to improve your credit score, what do? Well, we need to make sure we pay on time. And that's the biggest influence. You're going to want to, if you have high limits, you want to try to pay those limits down. And many times if you're applying for a mortgage, many times the lenders will say, hey, we need to get your credit score up, and the best thing you can do is, can you pay down some of these credit scores so that we have more of that delta between your balances and your credit limits. So length of credit, we need to make sure that we're creating longevity on those accounts. And credit mix, we've already talked about that, as well as new credit, just, buyer beware. And some other things you can do too is the reason why you want to watch your credit report, and that's why I have that free credit report that shows up each month, is because if your credit score goes, way down because you're getting some type of report that tells you that, sometimes things show up on credit reports that aren't supposed to be there. So you want to notice that right away. And if you look at your credit report, you can get a free credit report by any of the bureaus. You can ask them for a free credit report, and I recommend you do that. And just see if there's anything. I mean, over the years, I found a number of things that weren't mine, but somehow they got attached to my credit score. So you want to dispute those, and you want to just make sure that your credit report is clean and up to date. So those are some simple things to be able to affect your credit score. Now, if you need help raising the score, there's other things that you can do outside of these more obvious ones by working with a debt, like a credit repair consultant. And my friend Devin Norcross, that's what he does. So in the description, if you want help, if you want some debt consultation and learn how to get some help to improve your credit score. For example, if you're applying for a mortgage, this is usually what this shows up. and you've learned that, hey, I really need some credit help in order to raise my score, Devin would be a great person to call in that case. So in the description, just click his link and he'll be happy to talk with you. He's part of our Wise Money team. All right, so 5 things that influence it. Here's the credit scores. Now, why is having a high credit score important? It's important because we borrow. In our lifetime, we need to borrow. We need to borrow for a mortgage, for a house. We need to borrow for cars. We borrow for credit cards, so on and so forth. So the higher you are, the better rates that you get. And let's break this down. So I started looking at this and I wanted to say, okay, let's see how much more somebody will pay in interest for a car, for example, based on having this score versus this score. So let's break this down. So right now, when we're videoing this, recording this, the interest rate to buy a new car, a brand new car, I went online today, and a brand new non-luxury class car is around $44,000. That's the average car price for non-luxury. So you want to buy a $44,000 brand new car, and you have exceptional credit. So you have kind of in this range, kind of very good, exceptional. Your interest rate be about 5.83%. All right, so now we just go down there, and this is called like super prime, prime, subprime, like they have these names of where you fit. But let's just go down. So exceptional is 5.38. We have 6.89% for very good, 9.62%, 12.85%, and 15.62%. Whoa. Whoa, right? So look at this difference for the same car. And I just went in and I think I went to Credit Karma or something to look at this and I was shocked, like, holy cow, 15.62% versus 5.38%. So we both want to go to both want the same brand new car. We go to the exact same dealership, get the exact same car. I have my 801, so I get a 5.38%. You have a 579, and to buy the same car, you're paying that 15%. So how does that break down in payments and interest? This is even more shocking. So the payment doesn't look too different, but when you look at the total amount of interest, so let's say we're going to get a 48-month loan. Now, if you go to my video that says the one thing that's keeping you broke, I think this video has one of my highest views. It is so good. So watch this video because it's really going to break down how much money your car is costing you for reals. So, but in that video I say, don't get a loan for more than 3 years, 36 months. But most people are getting 60 months loan, which is 5 years. But in this case, let's break it down and kind of split the difference with the 48-month loan. So the 48-month loan, this is the payments. We have the payment here on this is $1020. The payment is $1057. We have $1107, $1177, and $1238. All right, so it's a couple $100 more between these two. At the end of the day, maybe it doesn't sound like a great amount, but let's see, like over the 48 months, what the difference is in interest, meaning the amount I pay the banks in interest and the amount the money you pay the banks in interest. This is where it gets amazing. So total here is about $5,200 in interest. So I bought a car for $44,000, but I'm paying close to $50,000 for the car after it's all paid off. So $5,200. Then it goes up to $6,400. Then it's $9,000, $12,500, and $15,500. Look at this, you paid $15,000 more on top of that $44,000 car. So you paid $10,000 more than I did for the exact same car with everything else staying equal. So this is the number one reason why we want to keep our credit score high, because it saves you money. You're radically penalized for poor credit scores. Now, when you go to buy a car, they're not telling you that. They might not even be telling you the rate. They're just telling you the payment to see if you can afford the payment or not. So one reason. Now, another reason why we want to keep the credit score high is because to get a mortgage. And the number one reason why people can't buy a house is because of their credit score. And it's devastating. I've worked with so many families in my past where we're under contract, they're super excited, and then come to find out something's on their credit report, they weren't prepared, it wasn't high enough, and then couldn't buy the house. So yeah, buying a house, buying cars, credit cards, if you're going to get credit cards, many times it's higher interest. You're going to get quoted quite higher interest rate if you have a lower credit score. So it matters. Like the interest rate matters, and it really adds up a lot over a very short period of time. So yeah, getting loan approvals, higher interest rates, also credit limits. If you have low, usually many times, you have a lower credit score, you need the money the most. I mean, you're in a financial situation many times in life where, man, life is in a crisis situation and I need money and you're maxed out. My son is in that situation. He's 29 years old and, he's got newer credit, so his credit score isn't high enough. And he can't get access to much credit. He wants to, buy a car and do different things, but they say you can only get so much credit. So that's another thing, that the better your credit, the more credit limits, the higher credit limits you can have. And then the higher credit limits you have, many times you can have access to a lot more opportunities. So in many cases, like my strategy is I want to have a lot of credit limit, because if I need to borrow real estate, new business, to create a new opportunity, if it's, 6 figures or more, I need access to capital. So I want really high credit limits. Now I have no debt, so I pay off all my credit, but I want access to credit. I want access to as much credit as I can get, so if I need it, it's there. So the higher your credit score, they'll keep expanding your credit limit, as long as you're, for your sake, don't do that if you're not responsible, because you don't want to max that out, obviously. So yeah, you get better interest rates, loan approval, credit limits. Another thing that I just learned not too long ago is that I was talking to my insurance agent. One of the things that I do every year is that I renegotiate all of my insurance. And so your mortgage, I have lots of different houses. And so I call my insurance agent and we shop insurance, because I'm always working to get the best deal on homeowners insurance for my different houses. Especially insurance keeps going up, so it's even more important to negotiate this. But the last time I did this, at the end of last year, I was talking to my insurance agent, and he says, oh, because your credit score is so high, you get this premium, you get the best priced insurance. And I said, oh, what do you mean? He says, yeah, we pull credit for insurance, and if you have high credit scores, we'll give you much better rates. And I didn't even realize that. So insurance, that's another thing. Insurance companies definitely, homeowners insurance, but it might be health insurance or different insurance they're looking at. And if you have lower credit scores, they're going to quote you higher premiums for your insurance. So that can be a big deal. That can add up to hundreds, if not thousands of dollars per year. And then obviously housing, can't get a mortgage, or you can pay higher interest rates. So sometimes my clients, because their credit score was lower, they couldn't go through regular Fannie Mae, Freddie Mac type lending. They'd have to go to a hard money lender. And hard money lenders, they got the loan, but they're paying 3 or 4x what the normal interest rate is. So even in your mortgage, if you have low credit and you really want low credit score and you really want the credit, you're going to pay more for it. And then what I've heard recently is that even many employers are pulling credit as far as part of the job applications. So I don't know, how prevalent that is, but I've heard many industries doing that. So again, if you're in a competitive situation for the same job and you have excellent credit and someone has poor credit, they pull, obviously you're probably going to get the job. All right, so to summarize all that, your FICO score really matters as part of our journey to build wealth, to become financially free, financially secure. If you looked at my last video, part of the puzzle is your credit score. So hopefully today you understand it a little bit better. And again, if you need help with debt settlement, maybe debt consolidation, or need help increasing credit score, in the description, click the link, talk to my friend Devin Norcross. He's the best in the industry. He will give you the consultation. If he can help you, great. If not, he's going to give you some tips on what to do to help improve your situation. All right, that's all I've got for today. Hit that like button, subscribe, send me a comment. I love when you send me comments. It makes my day when you send a comment. And if this was helpful, send it to a friend or family member to help them improve their FICO scores as well. All right, see you next time.